Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to be talking about the recent FOMC and how the Federal Reserve has announced that quantitative tightening will be ending on December 1st. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, the Federal Reserve just had their most recent meeting, the FOMC, and during it, they obviously announced that they would be reducing interest rates to 4%. If you go over to the watch tool here, you can see that the Fed essentially reduced rates to 4%. But really, what was more interesting is that Powell really pushed back on the idea of a rate cut in December, basically saying, you know what, it's not a foregone conclusion. And so previously, the expectation of a rate cut in December was more than 90%. If you go look at, say, the probabilities, or you go compare to prior months for the month of December, you can see that right now there's a 31% chance they're going to keep rates constant, whereas just a day ago, there was only a 3% chance they were going to keep rates unchanged. So the argument is that Powell really didn't like the idea that markets were already thinking that a rate cut in December was a foregone conclusion. And I think part of the rationale as well is related to the government shutdown. And, you know, he did say that the government shutdown will have effects, but that all those effects should be effectively rolled back the minute the shutdown ends. The primary issue, I guess, for the Federal Reserve, for an institution that is data dependent, is how can you clearly make decisions about monetary policy if you're not getting the data by which you need to make those decisions on? So that might have something to do with it. But more than that, Powell talked about how, you know, consumer spending was still strong, how the growth in the economy is still strong, how inflation is starting to go back up. And he's right, right? He's right. If inflation were to continue higher, and if the labor market were to, say, cool off between now and then, you have to wonder, like, would it really make a lot of sense to be cutting rates in December? We can't know what the future holds. So he's essentially saying, look, guys, if we start getting data that inflation's going higher and the labor market is picking back up, we can't assume that we're going to have a rate cut. So that was really the first surprise, because it wasn't really a surprise that they were going to cut rates. We already knew that they were going to cut rates. The odds were extremely high, and they had advertised it from a mile away. So now the Fed funds rate is at 4%. And if you go look, well, this is the price of Bitcoin, which everyone wants to see. But if you go look at interest rates, one of the things you'll, if I can bring it up here, one of the things you'll notice is that while it is at 4% now, while it's at 4%, it is still less than the 2-year yield. Sorry, it is still more than the 2-year yield. So the Fed funds rate is still higher than the 2-year yield. And if we were to overlay the 2-year yield onto the chart, one of the things you'll notice is that historically, the Federal Reserve follows the 2-year yield. The 2-year yield does not follow the Federal Reserve. And you can see that pretty clearly when you look right here, how the 2-year yield topped out and it started going down, and then the Fed followed by reducing interest rates. It's just like when the 2-year yield went up, the Federal Reserve followed and raised rates. And you can see this time and time again throughout history, where the 2-year yield will go in a certain direction, and then the Federal Reserve will follow. 2-year yield tops in 2018, started going back down. The Federal Reserve followed. So this is nothing new. The market tells the Fed what to do. The Fed does not tell the market what to do. It's the market that has the say. Now, the other thing that the Federal Reserve did that was the point of bigger discussion, at least for us on this channel, was that what about quantitative tightening? Like, how is that going to play a role here? And if you go look at what they said, and this is what we talked about yesterday, is they're likely going to make an announcement soon. We just don't know what month. It's possible that they would have come out and said that they would have ended QT in November. Like, that was a possibility. It was also possible that they would say in January. The banks were somewhat split. Some people thought November, some people thought early 2026. And so the Federal Reserve, I guess, effectively split the difference. And they're going to they decided to conclude the reduction of their aggregate securities holdings on December 1st. So we can say that quantitative tightening will be ending on the 1st of December. Quantitative tightening has been going on for a very, very long time. And if you go look, if we remove some of this stuff and we just go look at the balance sheet of the Federal Reserve, you'll notice that this phase of quantitative tightening lasted a lot longer than the last one. So if you look here in 2018, you can see that QT started as well, maybe late 2017, but you can see there is quantitative tightening going on in the same way that it's been going on since 2022. Now, a lot of people in the crypto space don't really like the assumptions that monetary policy might have some effect on the cryptoverse. But you'll also hear those same people lament as to why this cycle feels different. My argument is you can't have it both ways. You can't say that this cycle feels different, but also say that monetary policy has no effect. Obviously, monetary policy has an effect. When they are printing $6 trillion and lowering interest rates to zero like they did last cycle, we saw metrics like Bitcoin dominance generally go down because there was a lot of excess liquidity. And when there's a lot of excess liquidity, that liquidity looks for a home. And the more liquidity there is, the riskier assets that liquidity will chase. And that's how you had, higher market cap altcoins outperforming Bitcoin. But when you are in restrictive territory, when quantitative tightening is ongoing, and not just that, but when you also have the Fed funds rate running theoretically above the neutral rate, which again is an abstract and academic concept, which there's no proof of exactly where the neutral rate is, but it is widely believed that the neutral rate is below the current valuations. Some people think it's at 3%. Some people think it's lower. I take the 2-year yield as a generally good assessment of where the neutral rate is. So it is true that the Fed will be ending quantitative tightening soon. And it is true that the Federal Reserve lowered interest rates to 4%. But the 2-year yield is at 3.6%. It's actually gone up a little bit. And it usually goes up a little bit after a rate cut, especially when you have a rate cut not based on a crisis, but a rate cut based on more so risk management, which is exactly what these rate cuts are, right? They're risk management rate cuts, just as Jerome Powell said. And you could argue that ending quantitative tightening is also a form of risk management. It's just balance sheet risk management. Now, with all that said, we can maybe talk about what people actually care about. And that is, how does it affect risk assets like Bitcoin? And perhaps we'll also talk about the S&P 500 too. So, if we go take a look at Bitcoin, one of the things you guys have heard me say for a very, very long time, going back years, is that last cycle, we know that Bitcoin topped out before quantitative tightening ended. So if you look here, when Bitcoin topped, it actually topped just before the first rate cut in 2019. So to some degree, this cycle has already played out differently, because if you go look at the first rate cut in 2024, you can see that Bitcoin went up after it. So it's not apples to apples. Like, we're not comparing the exact same thing. Now, I will say that I do firmly believe that the top for this market cycle is going to be the fourth quarter of this year. And we've said that for a while, right? Normally, it's the fourth quarter of the post-halving year. it's not what I want to happen, right? Like, and again, like, I think people need to recognize that, from 2022 until 2025, I was bearish on the ETH Bitcoin valuation, and a lot of people took that out on me because they were motivated to think it would go up financially. So they took it out on me. But remember, like, I'm just telling you guys what I think. And what I think is that if you look at all prior cycle tops for Bitcoin, they occurred in the fourth quarter of the post-election year, or the post-halving year, right? You have Q4 of 2013, you have Q4 of 2017, you have Q4 of 2021, and I'm just simply suggesting, hey guys, there's a reasonable chance that we might have a top in the fourth quarter. So that's essentially what I'm saying, is that you might have a rate cut here you might have a top in 2025. I'm trying to make sure my screen is still looking good. All right, so now we just have to figure out, right? We just have to figure out if this time is different or if it's not. I subscribe to the idea that it's not. If it's not different, we then just have to figure out if the top is in. Because there was a top in October, and there's always a chance that that corresponds to the cycle top. If you look at the ROI from the low, you can see that, like it wouldn't be completely far-fetched for that to ultimately be the cycle top and for the low to just occur around next October. That's always a chance, right? There's always a chance. And so what I want to do in this case is, we know that, right? We know that. And we know that the sort of the timing on when to accept that the top could be in would be on weekly closes below the 50-week moving average, on 2 weekly closes, as historically two consecutive weekly closes. Historically, that's what marks the end of the cycle, right? It doesn't tell you when the top is in, it just tells you when the cycle is definitively over. And I mean, it does tell you that the top was in, but it doesn't tell you in real time, right? So if you get weekly closes below that, there's a decent chance that the cycle is coming to an end. Now, what's interesting is this cycle, we have not really seen euphoria in the way that we saw in the fourth quarter of 2013 and the fourth quarter of 2017 and the fourth quarter of 2021. We haven't seen euphoria. And so it raises the question, well, why not? And like, why would this time be different? Or maybe it's not. Like, maybe we still have a parabolic rally ahead of us and we're just all too impatient to see it play out. And I do want to remind people that it is a valid option. If you overlay total assets held by the Federal Reserve with interest rates, one of the things you'll notice is that Bitcoin topped before quantitative tightening ended. And so if you look at today, right, if you look at where the top has been so far this cycle, and we note that QT will be ending in December, you could argue that, all right, well, if it plays out like 2019, maybe that ends up being a local top. Now, there's sort of two different ways to look at this. One way is if the top is in, then you might not have nearly as massive of a drop as in prior cycles. You might have more of like what you saw in 2019, where the price just hovered above 10K for a while. So what if we are in a similar phase where if you look at the 2019 move during those rate cuts, during quantitative tightening, Bitcoin was essentially holding just above 10K for months. What if we're doing the same thing this cycle, but instead of 10K, it's 100K? Just 10x the move. Now, that doesn't necessarily mean, though, that the top has to be in. And so you have to ask yourself, well, if last cycle rate cuts signal the top, well, then they didn't this time, right? Because again, if you look at 2019, when rate cuts started, the top was in. Rate cut started in September, I believe, of 2019, or no, maybe it was July. It was July, but still, the top was in. And so in this case, if last cycle when rate cuts began, the top was in, if we had assumed that this cycle, we'd have missed out on a lot of gains. So in the same way with quantitative tightening, it would be really easy to assume right now that the top is in, especially with Bitcoin just stuck in traffic on Struggle Street for the last several weeks. Be easy to assume that. And honestly, we need to take that into consideration. I've said for a long time, I'd say there's like at least a 40% chance that the top of the cycle is in October. But we also have to be flexible and say, well, if last cycle rate cuts didn't mean if last cycle rate cuts meant that the local top was in, but this cycle it didn't, does that mean that last cycle quantitative tightening starting meant the top was in 3 months before? Does that mean it has to play out the exact same way this cycle? And so I think what you have to do is you have to go back and you have to look specifically at why the Fed was cutting in 2019 and why the Fed was ending quantitative tightening in 2019, right? Because the reasons matter. And one sort of way to think about like why the reasons matter, if you look at just the S&P 500, right? One of the things you could say, and a lot of people have said, is that a lot of times people say, well, when rate cuts happen, that's when the markets fall off a cliff. And they're right. That there are times in history where rate cuts happen and it's a really bad recession, right? Like look at this. In 2007, rate cuts didn't do a thing to help revive the stock market for over a year. In 2001, rate cuts didn't do a thing to revive the stock market for years. So you could look at that and say, well, all rate cuts imply that the markets have to go down. But if you look at 2019, you can see that rate cuts were happening and the market went up. And if you look at this cycle, rate cuts were happening and the market went up. So it matters why, right? There's some level of like, if you're going to cut rates when the Fed doesn't need to, if it's not in response to a crisis, then it's bullish. If the Federal Reserve is cutting rates in response to a crisis, then it's bearish. So the reason matters. So then why was 2019 different than the other cycles? Well, you could argue that the economy, while it was somewhat weaker and inflation was kind of trending down, it wasn't nearly as weak as what we saw back in the dot-com era. In fact, if you were to simply overlay the unemployment rate onto the chart, and you look here at 2019 when the Federal Reserve was cutting rates, the unemployment rate was trending down, right? It was trending down. Now this time, it's actually been trending up as they've been cutting rates. But the reason the market has not cared is because the unemployment rate has been trending up in a somewhat controlled fashion. It has not really entered into this sort of this nonlinear phase where it just goes parabolic and everyone starts panicking. I believe that will be the end of the cycle. The end of the business cycle will occur when the unemployment rate aggressively goes up. And that's how the business cycles work. That's how they've always worked. Timing is hard. Timing is hard. So in this case, since we know that not all rate cuts have to mean the top is in, does that mean that QT has to mean the top is in for Bitcoin? Not necessarily. You could look at and I pulled up here some of the prior announcement dates for the last cycle, and you could look at that and say, all right, well, back in 2019, the Federal Reserve, it looks like they announced the end of quantitative tightening. They announced it in July. Okay? So when they announced it, Bitcoin had already topped, and they announced it would be ending, in the last month would be August, and so September you would start to visibly see the balance sheet going up. So that's why a lot of people just say it was September, although I think August was the last month where they let the balance sheet roll off like that. And the top was, of course, in. But why did the Federal Reserve end quantitative tightening in 2025, right? Well, to some degree, in 2019. Well, why don't we start in 2025? Because we're already in 2025. In 2025, as we talked about, yesterday, one of the main reasons was liquidity in money markets. There's a little bit of strain in money market accounts, and so by ending QT, that helps to reduce that strain. They want to make sure that liquidity is not an issue, that banks are doing just fine. Furthermore, the reverse repo facility had fallen significantly, and it was kind of a sign that all this excess liquidity from the pandemic was gone and that people weren't really using it anymore, right? So if you look at the reverse repo facility, you'll see what I'm talking about. Let me just remove these moving averages. So here you can see reverse repo is essentially back. I mean, it's back to 20 billion. So it's way back down. All this excess liquidity that we had during the pandemic is gone. So the the reverse repo facility isn't really being used as much now than it was. And so the Federal Reserve risks that if they continue quantitative tightening beyond this point, then it can really start to negatively impact the banks. So the 2025 decision to end quantitative tightening is mainly about just preserving liquidity, right? Preserving the function of the market, and it is a risk management tool. The Federal Reserve has sort of flushed excess liquidity out, right? It's gone at this point. And so they risk, if they continue, then starting to have very negative impacts. Now, in 2019, it was somewhat different, right? In 2019, the Federal Reserve announced in July that they were going to reduce, or they were going to end quantitative tightening in like August, and therefore you would see it in September. So they had already pursued like normalization of their balance sheet for a while, not as long as this cycle, but it had been ongoing for I think like at least a year and a half, right? Like from like 2018 and then like half of 2019. So back then, the Fed recognized that the reserves and liquidity in the system were becoming less abundant, like they were today. But the main difference is that in 2019, the macro environment looked a lot different, right? There was more of a global growth slowdown. And I know what you're thinking. You could say, well, that's the same thing as today. Maybe, but that's not really what real GDP continues to indicate, right? The United States continues to expand. And again, sometimes that can change. Also, back then, we were having weaker inflation, right? Weaker inflation, not stronger inflation. So if you were to overlay the United States inflation rate year over year, and you were to look here at 2019, in August, in July, you can see that inflation was actually below 2%, right? It was below 2%. And then right after they ended quantitative tightening, inflation went up, right? It went up. So now they're ending QT, but inflation is above target and it's been trending up. So one thing we have to remember is that the Federal Reserve absolutely risks rekindling the animal spirits in the market. And you guys know what I'm talking about. It's that feeling of FOMO, the feeling of like, oh no, I'm going to miss out, and everyone just piles in. And one great example of that is to simply look at interest rates in the 1990s and note what the Fed did. And what you have to do here is you overlay the S&P 500. We're going to have to wrap this up soon. But you overlay the S&P 500, and you see that the Fed was lowering rates, and then they raised them, and then they lowered them, and they had to raise them again to ultimately kill off the animal spirits. So the Fed does risk, and this is what Powell was worried about, if they lower rates too much, and, they start printing and whatnot, they do risk rekindling the animal spirits in all of us, and thus needing to then raise rates later on. And that's how one way you could ultimately kill the animal spirits of the market is to go about something like that. And so, you can see that back then they lowered rates, it rekindled the animal spirits, markets went up, they eventually had to raise rates to ultimately bring back down the market and get a hold on things and not let valuations continue to just melt up for too much longer, bring us back down to sort of reasonable valuations. Okay. So in both 2019 and 2025, liquidity was a concern, right? There were strains in money market accounts back then, just like there are strains today. But some of the differences are that in 2019, the Fed was more worried about weaker inflation and wanting to kind of get that back up. Like, because if you go negative, if you go below zero, you become deflationary. And while that sounds good in our minds, it's really, really, really bad for risk assets. And so macro policies are different as well. There's a lot of differences, right? Like there's a lot of differences that we could point to. You could point to like global tensions were different back then. You could point to inflation is different today. You could point to all sorts of things. But at the end of the day, the one thing we have to like make sure we don't fall into the trap of is assuming this time has to be different just because we want it to be. Okay? So the way I would think about it is like this. Back in 2019, when Bitcoin topped before QT ended, you'll note that it stayed around those prices until September, right? Until the month that QE started. Bitcoin had a big drop when quantitative easing started. So what I would say is, if it does play out the same and the top is in, then you might see something similar where there's a big drop that occurs around the time that QT actually ends, or maybe just after it, if we can't move up between now and then. And so essentially how that could play out is like everyone's like waiting for QT to end, and everyone's waiting for QE to begin, and for more rate cuts. And then like if Bitcoin isn't going up, and then that time comes and goes, and there still isn't a rally, then people give up. They're like, well, QE hasn't fixed it. Lower interest rates haven't fixed it. Guess the market's got to go down. There's still time, though, right? There's still time for something else to happen. So I would say this. No one has a crystal ball. We all wish we did, right? I wish I had a crystal ball. I wish I could tell you guys exactly what was going to happen. But the way I would think about it is as such. If Bitcoin is not able to move higher by December, then it's probably not going to for a while. What's probably going to happen is we're going to go into this phase for 2026, where the market starts to just slowly go down, right? Not a crash down, not like a massive crash down, just slowly down. And the reason it wouldn't be a massive crash would be if we don't actually get euphoria, right? If we don't actually have that euphoria. When you have euphoria, you get massive crashes. When you have Bitcoin dominance at very low levels, you have massive crashes. Right now, we're at higher Bitcoin dominance levels. Now, the other thing to look at here is when Bitcoin dominance was at this same exact level in 2019, right here, it was actually just before the top was in, right? Because what happened is Bitcoin dominance exploded higher, and it exploded higher, and Bitcoin USD went to a new high as the altcoin market bled away. And that's what's been happening all cycle. Bitcoin keeps going to higher highs. Altcoins are hardly doing anything. Some of them go to new all-time highs, but most of them don't. So that's why I would say, in an environment as uncertain as this, if you're going to hold something in crypto, Bitcoin is the best play. Because dominance will likely go up. It likely will. In fact, did you know that in 2017, total 2 minus USDT divided by Bitcoin, right here, was at the same value that it is today, right? We live in a simulation sometimes, it feels like. Because again, in late October, early November 2017, total 2 minus USDT divided by Bitcoin, same valuation as it was today. What happened back then is it went down, it then got another rally, and then it went down again, and then it got a bigger rally. So I just want people to think about this stuff, because you could have alt Bitcoin pairs drop into early November, then get some type of like counter trend rally as people prepare for QT, and then Bitcoin liquidity takes over going into December, because December is normally Bitcoin's month for liquidity to flow back to that, and then QT ends in December, and then alt Bitcoin pairs potentially find a low. I think it could play out like that. So the best case, like the best reasoning for like why Bitcoin could still maybe go higher would be that would simply be that altcoins liquidity is likely going to go back to Bitcoin. And if that's true, then maybe Bitcoin could go higher one final time before the cycle's over. The only other thing I'd point to that is extremely, extremely dubious, I'm not asking you to take this to the bank, is that in 2019, the top was around 14K. Around 14K. We were to 10x that today, it puts you around 140. Okay? The reason why all that's interesting is because if it works out like that, then all these lows would be fairly interesting lows, right? Because you would have one low at 74K. This one was at 7.4. So if we were to go to 140, then that would get a 50% drop, would get you to 74K, which is exactly the low that Bitcoin had back in May. That would act likely as a support level. And then the other thing is the next low after that was like around in the 60K range, which again is the prior all-time high. So let's keep an open mind. Let's see what happens over the next month or two. If by December Bitcoin is still not at all-time highs, then it's likely not going to be. But if we go to new all-time highs and we go to 130, 140, there's a good chance we're flirting with the market cycle top. Regardless, Bitcoin's a better hold for now. We'll see if that changes in a couple of months. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.